Have you ever wondered how money came to be? What did people do before coins and banknotes existed? This is a question that piques our curiosity and takes us back to a time when the concept of money was as alien as a world without it seems to us today. Let's venture back to the beginning, where it all started with the barter system. In those days, people traded goods directly. A sack of grain for a clay pot, a cow for a handful of seeds. It was simple, but it had its flaws. The major problem was the lack of a common measure of value. How many pots is a cow worth? How many seeds make up the value of a sack of grain? The barter system was inconsistent, and it made trade incredibly difficult. That's when commodity money entered the scene. This was a type of currency that held intrinsic value, things like gold, silver, salt, or even cattle. These were items that were widely accepted because of their utility or value. They became a common measure of value, solving the problem of the barter system. But as societies grew and economies expanded, the use of bulky and perishable commodities became impractical. And so, the evolution of money continued. Around 600 BC, the first minted coins appeared in ancient Lydia, modern-day Turkey. These coins were made of a mixture of gold and silver called electrum, and they had a designated value, making trade more standardized and efficient. Fast forward a few centuries, and we see the introduction of paper money, first used by the Chinese during the Tang Dynasty. This was a revolutionary change. It was lightweight, easy to carry, and it represented a promise to pay the bearer a certain amount of gold or silver. And so the journey of money continued, from barter to commodity, from coins to paper. As societies grew and economies expanded, so did the complexity of our monetary system. But this was just the beginning. The story of money is a fascinating tale that continues to unfold even today. It's a tale that has shaped and will continue to shape our world in ways we can't even imagine. So buckle up as we delve deeper into this captivating narrative. From coins to paper to plastic and now, digital. Money has had quite a journey. Our story takes us back thousands of years when the earliest form of money was livestock or grains. Imagine trying to buy a loaf of bread with a cow. Then we moved to precious metals. Gold and silver were desirable, easy to mold and hard to fake, making them perfect for coins. But carrying around a bag of gold coins was heavy and risky, so paper money was introduced, first in China and then across the globe. But paper money wasn't always just paper. For a long time it was backed by gold. This is known as the gold standard. Under this system, you could exchange your paper money for a fixed amount of gold. Sounds great on paper, right? But there were problems. If there wasn't enough gold to back the money, it could lead to deflation, causing prices to fall and economic activity to slow down. So, we moved on to fiat money, which is what we use today. Fiat money is not backed by a physical commodity like gold. Instead, it gets its value from the trust and confidence people have in the government that issues it. The government declares fiat money to be legal tender, which means it must be accepted as a form of payment. But the evolution of money didn't stop there. As technology advanced, we saw the introduction of credit cards and electronic banking. Money became more abstract. It was no longer something you could hold in your hand but numbers on a screen. And now, we're in the era of digital currencies like Bitcoin. These are not issued by any government and are entirely digital. They promise a future where money is decentralized, borderless, and can be sent from one side of the globe to the other in an instant. And so, we have arrived at the era of digital money. Now that we've looked back, let's focus on the present. How does our current monetary system work? Let's start with the basics. At the heart of our modern monetary system are the banks, and overseeing them, the central banks. Banks are not merely vaults for our savings, but key players in the economy. They take in deposits from savers and lend this money out to borrowers, facilitating the flow of money in the economy. Then we have the all-important central banks. Central banks are like the puppet masters of the economy, pulling the strings behind the scenes. They control the money supply, which is the total amount of money circulating in the economy. They do this through various mechanisms, such as setting interest rates and buying or selling government bonds. Speaking of interest rates, let's delve a bit deeper. Interest rates are the cost of borrowing money. When you take out a loan, you're not just paying back the money you borrowed, but also an additional amount, the interest, for the privilege of borrowing. Central banks adjust interest rates to control inflation and stimulate economic growth. Lowering interest rates makes borrowing cheaper, stimulating spending, while raising rates makes borrowing more expensive, curbing spending. Now, what about money creation? You might think that money is only created when governments print new notes and mint new coins. In reality, most of the money in our economy is created digitally by banks when they make loans. This is known as bank money. Let's break it down. When banks lend money, they don't physically take cash from their vaults and give it to borrowers. Instead, they create new deposits in the borrower's account, effectively creating new money. This process expands the money supply, stimulating economic activity. But this process also has a downside. If banks create too much money by lending too freely, it can lead to inflation. Inflation is when the prices of goods and services increase over time. While a certain level of inflation is healthy for the economy, too much can erode the value of money and destabilize the economy. On the flip side, if banks create too little money by lending too conservatively, it can lead to deflation. Deflation is when the prices of goods and services decrease over time. This can discourage spending and investment, leading to slower economic growth. So in essence, our modern monetary system is a delicate balancing act. Banks and central banks work together to control the money supply, adjusting it to maintain a stable economy. They have to ensure there's enough money to facilitate economic activity, but not so much that it leads to runaway inflation. This brings us to the end of our overview of the modern monetary system. It's a complex web of interactions and mechanisms, but at its core, it's all about balance and control. Understanding these concepts is key to navigating our modern economy. What does the future hold for money? Could we be saying goodbye to physical cash? As we navigate through the 21st century, we find ourselves on the cusp of a potential monetary revolution. The future of money may very well be digital, and we're here to explore what that might mean. Let's start with digital currencies. Ever since the inception of Bitcoin in 2009, we've seen an explosion of digital currencies, also known as cryptocurrencies. But what are they? In simple terms, cryptocurrencies are digital or virtual currencies that use cryptography for security. They are decentralized and operate on technology called blockchain, which is a distributed ledger enforced by a disparate network of computers. Cryptocurrencies offer a number of potential advantages. For one, they can make transactions faster and cheaper, especially international ones. They also provide a level of anonymity that traditional banking systems cannot. And because they're decentralized, they're not subject to the control of any government or central bank. But it's not all roses. Cryptocurrencies come with their fair share of challenges. Their value can be highly volatile, and the technology is still relatively new and unproven. Plus, the anonymity they provide can be a double-edged sword, potentially facilitating illegal activities. Now, let's turn our attention to alternative payment systems. With the advent of mobile technology, we're seeing an increase in the use of digital wallets and contactless payments. Think about how often you use apps like Apple Pay or Google Wallet. These systems are convenient and fast, making it easier than ever to pay for goods and services. Yet, like cryptocurrencies, they have their downsides. Not everyone has access to the necessary technology, which can create a digital divide. And then there are concerns about security and privacy. After all, every swipe, tap, or click leaves a digital footprint. Finally, let's not forget about the potential societal and ethical implications of this digital monetary future. As we move towards a cashless society, we must ensure that everyone has access to these new forms of money and payment systems. If not, we risk exacerbating economic inequality and leaving the most vulnerable behind. Additionally, the shift to digital currencies could have significant implications for monetary policy. How will central banks control inflation and interest rates in a world where cryptocurrencies rule? These are questions that economists and policymakers will need to grapple with in the coming years. In conclusion, the future of money is indeed exciting. We're on the brink of potentially transformative changes. But as we embrace these new technologies, we must also be mindful of the challenges they present. As the saying goes, with great power comes great responsibility. The future of money is exciting, but it also comes with its own challenges. One of the biggest buzzwords in finance today is cryptocurrency. But what is it really? Simply put, cryptocurrencies are digital or virtual currencies that use cryptography for security. They are decentralized systems that allow for secure peer-to-peer transactions to take place over the internet. These transactions are verified by network nodes through cryptography and recorded in a public ledger called a blockchain. Bitcoin, the first and most recognized cryptocurrency, was created in 2009 by an unknown person using the pseudonym Satoshi Nakamoto. The decentralized nature of cryptocurrencies offers a major advantage: freedom from central authority. This means they cannot be controlled by governments or financial institutions, which can lead to lower transaction fees compared to traditional online payment systems. Cryptocurrencies also offer the potential for anonymity, though this can be a double-edged sword, leading to their use in illicit activities. However, cryptocurrencies are not without their disadvantages. Their value is highly volatile, leading to potential financial risk for investors. Additionally, because cryptocurrencies are still relatively new, they are not widely accepted as a form of payment. There are also concerns over their environmental impact, as the process of mining cryptocurrencies requires a significant amount of energy. Looking to the future, the potential of cryptocurrencies is vast. They could revolutionize the way we conduct transactions, offering speed, security, and efficiency. However, this future is not without challenges. Regulatory and security issues need to be addressed, and the public will need to become more comfortable with the idea of digital currencies. Moreover, cryptocurrencies could play a key role in financial inclusion, providing access to financial services for those who are currently unbanked or underbanked. This could be particularly impactful in developing countries where access to traditional banking services is limited. Cryptocurrencies are reshaping our monetary system, whether we're ready for it or not. As we continue to explore the possibilities and navigate the challenges, one thing is clear: the world of finance as we know it is changing, and cryptocurrencies are at the forefront of this transformation. Let's talk about debt. It's a word that makes many of us uncomfortable, but it's a crucial part of our monetary system. Debt, in its simplest form, is money borrowed that must be repaid, typically with interest. It's like a double-edged sword. On one side, it can stimulate economic growth, and on the other, it can lead to financial crises if not managed properly. So why is debt so central to our monetary system? Well, debt is the engine that keeps the economy running. You see, when banks lend money, they're essentially creating new money. This is because the money that banks lend isn't usually made up of their deposits. Instead, they create new deposits when they make loans. This is known as fractional reserve banking. This new money then circulates in the economy, driving economic activity. Businesses use loans to invest in capital, individuals use them to buy homes and cars, and governments use them to fund public projects. All these activities contribute to economic growth. But debt is a tricky business. It needs to be just right. Too little, and economic growth can stagnate. Too much, and it can lead to inflation, where the prices of goods and services rise, eroding the purchasing power of money. Managing debt is like walking a tightrope. Central banks play a crucial role here, using tools like interest rates to keep debt levels in check. High interest rates can discourage borrowing, helping to cool down an overheated economy. On the other hand, low interest rates can encourage borrowing, stimulating economic activity. However, there's a dark side to debt. If it becomes unsustainable, it can lead to financial crises, as we've seen in the past. When borrowers can't repay their loans, banks can go bust, leading to a domino effect that can bring down the whole economy. So it's a delicate balance. Debt can be a powerful tool for economic growth, but it can also be a ticking time bomb if not managed properly. Debt might be a daunting concept, but it's an integral part of our financial lives. We've traveled from the past to the future of money. So, what have we learned? We've seen how money has evolved from a simple barter system to complex digital currencies. We've delved into the intricacies of the modern monetary system, understanding the pivotal role that banks, especially central banks, play in money creation and distribution. We've explored the multifaceted world of cryptocurrencies, weighing their pros and cons. And we've scrutinized the role of debt, an often overlooked but crucial component of our monetary system. Looking ahead, we're on the cusp of an exciting era. Digital currencies and alternative payment systems may well redefine the way we think about and use money. But as with every innovation, there are ethical and social implications that we must consider. The journey of money is a journey of innovation and change. As we look ahead, who knows what the future will bring?